Welcome to part 5 of our valuation series. I'm Hindol. We have built the foundation with DCF and multiples. Today we address the adjustments that often make the difference between theory and reality. We are going to talk today about control premiums. We're going to talk about liquidity discounts and other factors that can swing valuations by 30% or more. This is where valuation becomes intensely practical. So the first piece that we're going to talk about would be the control premium and minority discount. So this is going to be interesting. How do I say this? Let's start with control. A controlling stake in a business is worth more per share than a minority stake. Why? Because control gives you decision-making power. With control, you can set strategy, hire and fire management, determine capital allocation, decide on dividends and distributions, sell the company, even take it public. Now, these powers, they have value. Empirically, control premiums in M&A transactions average 20 to 40% over pre-announcement trading prices. But this is not a magic number you blindly apply. The premium, it reflects the value of changes the acquirer can make. If the company is already well managed and optimized, the control premium is lower. If there's significant opportunity to improve operations, cut costs, or redirect strategy, the premium is higher. The flip side is minority discount. If you own only, let's say, 15% of a private company, you have no control, or rather you have almost no control. You cannot force liquidity, you cannot change the direction. You are at the mercy of the controlling shareholder or the body of shareholders. This lack of control reduces value. In my experience doing M&A deals, the control premium is not just about legal control. It's about strategic options. It's about an acquirer paying a premium who is buying the option to integrate, to realize synergies, and to enter new markets. They are not just buying current cash flows, they are buying optionality. Remember that. The other piece is on liquidity discount. And what is a liquidity discount? Liquidity is the ability to convert your investment to cash quickly without significant price concession. Public stocks, they're highly liquid, right? You can sell millions of dollars in seconds. You go to Charles Schwab and can get it done. But private company equity is illiquid. It might take months or years to find a buyer, and you likely accept a discount. Liquidity discounts for private company equity typically range from 20 to 40%. Why such a wide range? It depends on several factors. First is the quality of the company. A profitable growing business with clear exit paths has higher liquidity than a marginal performer in a declining industry. Second, market conditions. In a robust M&A market with active buyers, liquidity discounts, they compress. In a downturn, do you know what happens? It expands. Then third, there are contractual restrictions. Buy-sell agreements, rights of first refusal, lock-up periods, these all reduce liquidity and increase a discount. I've seen people confuse liquidity discount with minority discount. Two different things. You can have illiquid controlling stakes and relatively liquid minority stakes. Think preferred stockholders with put rights. The academic research on this is clear. Investors, they demand compensation for illiquidity. The discount reflects both the time value of money while you wait for liquidity and the uncertainty about eventual exit price. Now let's talk about the next piece, which is very important, which is the key person discount. And that applies when a business is overly dependent on one individual. If the CEO is also the rainmaker, the chief technologist, and primary client relationship manager, their departure could devastate value. I typically apply 10 to 30% discount based on how difficult they are to replace. Can their knowledge be codified? Are customer relationships institutional or personal? Is there a succession plan? I've done valuations where we identified key person risk and recommended that the company take out key person insurance and implement knowledge transfer programs before an acquisition happens. The risk is manageable, but must be priced. Industry-specific risks might warrant discounts. Regulatory risk in healthcare, technology obsolescence in software, concentration risk if 60% of revenue comes from one customer. And then also geography concentration. If you're dependent on a particular market, Customer concentration is actually pretty important. The rule of thumb, if one customer represents more than 20 to 30% of your revenue, apply a discount. I've seen 30% discounts for businesses where 50% of revenue came from a single customer that could literally walk away the next day. On the flip side, premiums exist too. Strategic premiums when an asset is uniquely valuable to a specific buyer, synergy premiums, when the combination creates value beyond standalone businesses. Scarcity premiums for unique assets, a perfect geographic fit, proprietary technology, regulatory basis, or regulatory licenses. So here's a key insight. These adjustments are not arbitrary. Each should be justified with specific reference to value drivers and risk factors. So document your reasoning. If you apply a 25% liquidity discount, explain exactly why it is 25% and not 15% or 35%. Premiums and discounts can transform a valuation. A $50 million enterprise value becomes $60 million with a control premium or $35 million with combined minority and liquidity discounts. So, okay, in part 6, what we'll do is we'll explore how to value these intangible assets, these brands, these customer relationships, this intellectual property. They're assets that often represent the majority of modern business value. So I look to seeing you then. Take care. Bye-bye.